The same illustration, né? The same illustration between here and here. Which one has more bias? A or B? Which one has more bias? So now, going back to my question, do traders like to buy low or buy high? Back to the same question. Do traders love to buy low or buy high? Exactly. So now, my question to you is that why did you say that B, when we were looking at this, why did you say B has a lot of bias? Because it's a support. At this moment here, they are fearful here. The one thing that's going to entice them into getting into position is what? A break above this. You know, in modern terms, they call it break of structure. It's very comedic though. You know, you know, they even abbreviate it. They call it boss. What a world we live in. It's amazing. It's amazing that a person has to have something called a break of structure. Why do you need to have a break of structure if you cannot wait for something to break before you fix it? No. Break of structure is like you driving your car and not taking it to go get maintained. You are waiting for it to break before you can fix it. That's the same thing. Why are you why are you waiting for the market to break a structure before you can actually enter into a position? Because you doing so basically reflect the fact that you depend a lot on technical tools to such an extent that you wait for a structure to break before you can get into the market. Therefore, it does not show logic. It shows dependency on a specific tool. Therefore, you cannot think for yourself, by yourself, and actually do your own observation when looking at the market. You're waiting for the structure to break so that it can, you know, words of affirmation. Words of affirmation where you feel like, oh, they think I am cool. You know, before you start feeling cool yourself, someone has to tell you. Then majority of people, when they start telling you, you start feeling, okay, now, maybe indeed I am cool. That's basically when a trader depends on technical tools, and then not only depending on technical tools, but he wants a confluence. The word confluence, that means you need different people to come and affirm what the next person has just said. You know, I tell you that you look beautiful, but you do not believe. You want another source again to come and say you look beautiful. Then now, once you have gathered a magnitude of people that basically say the same thing, now you start to believe that indeed I do look beautiful. That is confluence. Having multiple instruments within the market affirming or confirming your decision. Coming together, agreeing that, oh, indeed, it is a buy. You see the danger in that. Let me show you the danger in that. Now, let's say maybe we want to be spicy, you know, we want to be a bit spicy. Okay? We want to be a bit spicy, you know. We're here. What is this? Tell me that this is not Confluence. Isn't this Confluence? Now, what is this? This is Confluence, right? If you can look at this, this is Confluence, right? Now, look at this. So this entire situation here, this is Confluence, right? Things are going in your favor. But you see the danger in that thing. Though like here, when there, it will work here and there. That's the problem. People see something working 40% of the time, and they automatically assume that it works 100% of the time, which is not entirely the case. But it's very nice to see, because on a higher time frame, this looks well, but go to a lower time frame, then you will see that indeed this is not the way. Because on a lower time frame, this movement, it took 2 months to push to the downside. On a lower time frame, this takes 2 hours. 2-3 hours after that shoots up. So if it spikes below, it will be 1-2 spikes below and then pushes to the upside. Here it gave you 2 hours, and then within an hour or two again it comes back. So you cannot trade like that. You understand? You cannot trade like that, because like it does not even give you time to, you know, take your partner to the movies, because you're glued to the screen. Are we okay with that? So now, with this being said, the thing that when we're saying that we're looking for possible long position at this area here, I want you to understand that we're looking for possible long position based on what? The main objective of us looking to take possible long position is to remove the floating supply. And if we were to remove the floating supply, our main objective is to attract new willing buyers. An attraction of new willing buyers gives us at least an influx amount or an increase in amount of willing buyers, therefore gives rise to short positions. So in a seller, not in a seller, I mean in a market whereby there is a constant increase in the amount of buyers. Therefore, that means that you being a seller, you are able to get your position filled faster than you being a buyer. Because like, let's take a look at this. You know, I want you to see it from the most simplest illustration, right? I know how much you guys like going to the grooves, you know. Let's say you go to the grooves, you know, you want to enjoy. Right now, if you were to go right now, you will definitely go to the counter and buy your 2 beers and go sit down, right? Are we okay? There are 3 bartenders, few guys there. You're able to get your thing bought. You buy your thing, and then you go and sit down and you're relaxed, right? Because now the seller has a lot of stock on hand. There's few people that are willing to buy, you know, so it's easy for you to get your orders filled. Then as the day continues to progress, now you start to realize that every time when I go by, I have to wait behind someone, and then after they have bought, then they attend to me. So now you understand that there is a reduction in your order being filled, the reduction in the time span. There is a reduction of the time. Actually, not even a reduction. There is an increase in the time you spend trying to buy, meaning that your order is not being filled, right? Then as the night continues to progress, now you get to around 9 o'clock. Okay? 9 o'clock, you're competing over price, isn't it? But in that scenario, you're not competing over price. You're competing to buy. You're out there raising your 200, you know, so that you can attract the bartender, so he can see that, you know, this guy has money there. He wants to buy, you know. Because now you are in a market that consists, you are basically put in a situation whereby now the people who are selling are fewer as compared to people who are buying. People who are buying have increased. There's an increased amount of willing buyers. You understand? So in the market, if you were to put yourself in that scenario, that means that it is better to become a seller rather than to become a buyer, isn't it? You guys get where I'm going with this? In that type of scenario, it is best to become the one who's behind the counter selling rather than the one that is in front of a counter buying. And we sometimes even during the weekend, I feel, I don't know, maybe the beer's increasing price, isn't it? Find that the bottle that you used to buy during the week, maybe with like 500, right now it's 540. So that's basically it. So now in this market here, you are yet to compete with buyers over sellers. But once the market pushes to the upside into this level